So let's have the panelists on the floor, on the board, on the stage. The question is, how can finance contribute to a sustainable and resilient post-COVID economy? The panel will be led by Rüdiger Fahlenbrach, professor at EPFL, at the Swiss Finance Institute at EPFL. And it will involve Andréa Maechler, member of the governing board of the Swiss National Bank. Andréa, please join us. And Patrick Odier, senior managing partner at Lombard Odier. You will handle the question? Of course, they come on the same thing as before, right? You have the question can come directly on the iPad of Rudy, and please take a seat. Help us answer that question.
All right, this is a tall order. Andrea, Patrick, thank you for being here. Sustainable finance is just such a vast topic that I thought we'd start with your own personal definition. What is sustainable finance for you, and what's the ultimate goal of it? Perhaps we'll start with you, Andrea.
Thank you very much. Sustainable finance for me would be reaching a financial ecosystem that is able to internalize all the risk in a sustainable way. So as an economist, the way I think about it is it includes what we call tragedy of the commons. So that means when individuals misprice the risk and may deplete the common good, like resources, but also what has been now coined by Mark Carney, by the tragedy of the horizon. So that is the inability to price adequately the risk, and therefore you don't think of the losses you cause today for future generations.
Thank you. Patrick?
Well, I think it's perhaps important to make an initial distinction between sustainability and then sustainable finance. Sustainability for finance is a major driver for return and risk. And if you look at it this way, it starts by having to define the global view of the world in which we are and try to understanding and perhaps translate that global view into major trends that will in turn internalize some of those more sustainable issues that we are all looking at, and understand from that perspective which are the perspective for every activity in the world, and from those activities then perhaps assess where those opportunities could be beneficial for investments and for capital to be allocated. If I may, I just would like to mention that capital is in this respect, and sustainable finance in this respect is one of the levers, of course. One of them is policy and regulation, which has to do with the efficiency of this transition, of course, and I'm sure we'll discuss it. The second is market forces, where schools such as this one and universities in general in these regions are very good at, understand what it takes for some industries to either be part of the solution or to be part of the problem. Or stay part of the problem. The third, of course, aspect is technology, of course, and the fourth is capital allocation. And when you look at capital allocation, our estimation is the sustainability transition or transformation, however you want to call it, represent about $10 trillion per year of opportunities. I'm sorry to say capital is usually interested by those opportunities, and will try to harness these opportunities as well as it can. And if it is the case, I would simply say that sustainable finance is the set of instruments, techniques, metrics, and approaches to how to correctly take advantage of that transformation from an investment return point of view and from a risk return point of view.
So I think this is a fair point. We heard this at the end of the previous panel. There is kind of society, there is government. Why would finance be so suited for a sustainable future? What's the edge that we have as central bankers, as finance professors, as finance professionals? If a government doesn't want to use fossil fuels anymore, it could forbid it. If we as customers don't want something anymore, we could not buy it. Where's the edge of finance? And what would finance do something that we just don't want, perhaps, as a society?
Is it to the central banker or to the banker that you're asking the question?
I don't know who answers first, the central banker or the regular banker.
I think I like for us, a very important angle is addressing the risk. From a central bank perspective, I mean, you have to understand we take a very different position. What are we? Our role, our mandate is really to be the guardian of financial and monetary stability. It's an important role because no one else can take this role. It requires a very different set of tools, a very specific and unique mandate. If we don't fulfill this mandate, no one else has the right set of tools to do that. Now, how do we do that? It is about addressing the risk. And so, as a central bank, we have a responsibility to understand changes in the landscape of risk, to understand what it does for the economy, what it does for price dynamics, economic cycles, is one thing that's very important for us. Another thing is, what does it do for the stability of the financial system? To what extent can climate risk affect an entire banking system? So that's about, it's about what banks have on their balance sheet. It's about correlations. Like a simple example, if suddenly there's no more snow in the Swiss mountains, would that have an impact on the banking system? In Switzerland, it wouldn't, because we're highly diversified and we have a solid banking system. But those are things that are very important, and that is where the way we think about, and I like it's important to differentiate sustainability from sustainable finance. And another role we do have, as you know, we have become a very large asset managers, a manager of reserves, and the way we think about how we manage our reserve, it has to be risk-based. So it is about reducing the risk, and it is about having a long-term perspective on how to do that. And there's a lot of work to be done there to really understand how do we do that in a sustainable way.
Thank you for that approach, which is going to be complementary with perhaps with my remark. I think if I want to answer your question, I will start by recognizing a simple fact. The problem that we are facing today comes from a major market failure. And if it is the case that we are reaching some limits of our planet today and that our economic activities and growth is associated with more damage than benefits, I think it is also, as a consequence, correct to say that governments have a role to play. And this role is of course important, but it's not exclusive. This role has basically to do with setting a framework, perhaps with setting incentives, perhaps with our goals, and perhaps setting also sanctions and constraints that will guide industries and the real economy in general to the right, in the right direction. Now, of course, the private sector has a role as well, and finance in particular in the private sector. And in that sense, the fact that there is this combination of forces that is so important, and we should really recognize how the combination of forces here, not only government finance, but also with industry and perhaps other stakeholders such as civil society is important. I think it has to do with trust. As soon as government sets the framework, the right objectives, and perhaps some of the metrics or obligations for transparency, etc., capital will start to have trust in what's being done. And if capital has trust in what's being done, perhaps the movement towards reaching these goals will be accelerated. And in turn, if this movement is accelerated, governments and politicians will realize that this is the case and will perhaps say, hey, instead of doing it for the 15 or 20 next years, we're going to ask this to be realized in the 5 to 10 years. And capital will say, hey, if I want to take benefit of that transformation, I'll even pour more capital into it. And then this is a virtuous cycle. And that's the way I see really the role of finance, is to make sure that it is at the same time trying to analyze and benefit from what the framework is going to be, trying to, of course, intervene as soon as possible within this framework, but also try to facilitate the reaching of some of the objectives that policymakers are trying to do. And all this, again, in the perspective of having a fiduciary responsibility for most of the capital, i.e. making it for the purpose of managing risk correctly and harnessing the good opportunities.
Thank you. And Andréa brought up a topic of risk versus perhaps impact. So when we think about sustainable finance, risk management might be there is a fossil fuel company, they might have stranded assets in the ground and they're never going to get to it. Impact, perhaps more loosely, is making the world a better place. Patrick, when you talk to your clients, what do they want? Proper risk management or having an impact on the world?
Well, of course, there are clients that do make values and moral postures converge with their investment philosophy, and that's good. Actually, you don't need to have this demand to make sure that this is the case, because actually going in the directions of investing into more sustainable, impactful investment opportunities will probably foster sustainability in all sense of the term. Inequality will be reduced, precarity will be reduced, pollution will reduce, etc., etc. So I think we are on the right track. Now, impact in this respect has to be viewed as the result of allocating capital in one direction. You can do it two ways. You can do it in an indirect way, and you can do it in a direct way. And I think most of our clients today are faced with some limitation as per to do it in a direct way, and some facilities, and including competences from our sector to do it in an indirect way. In this respect, you're owning some impact, or you're making some impact. If you own a company that is changing its practices and its business model at the same time, and I'm insisting not only the practices, but also the business model, the how and the what, you're probably going to own some impact indirectly. You're not going to be the one that has made it, but you have chosen the good horse, if you wish, or the good industry or the good company to have done it. And clients, of course, will usually look at this because it's easier to understand, perhaps easier to get to. And the other way to do it is the direct way, by having, and this is developing faster now, private asset types of projects in which they invest directly, because impact is measurable directly with a clear relationship with the investment that these clients have made directly into the solution. So both aspects are important. I think all this has to do with the triple dimension: risk, return, impact, but not of impact first and risk after, or risk first and the rest after.
Thank you. Andréa, the Le Temps, the local newspaper here, ran an interview with you, which was actually nicely balanced, but they put the headline of you're quoting you that the Swiss National Bank's billions cannot save the planet, something like this. You want to react to it?
So it is a message I have to give, is the Swiss National Bank does not have a mandate to promote climate change. We do have a very clear mandate, and it is not about having impact in making the world greener. We do have a very important, and I don't want to say this in a defensive way, but it is because we have an impact that is very important. You mentioned it, you need framework conditions. We heard it in the previous panel. We need good conditions, and one of them is price stability. What is price stability? Price stability, it is about trust. It is about confidence. It is about knowing, having confidence in the purchasing power of your money going forward. And that is very important. And then, so this is what we produce. And then it is for other actors, governments, civil societies, to use those good conditions to then do what they want to do, to discuss and come up with structural policy. So for us, and that was basically the idea behind the quote, we do have a very large balance sheet, but we cannot use it from an impact perspective outside of our mandate. And it is a very, because in the end, our balance sheet, it's actually become billions of Swiss francs, is actually a direct consequence of our monetary policy. It comes from the intervention we do on the FX market. It is a consequence. And we cannot just use them in a way that could go against our monetary policy, because otherwise we can do what we're doing in order to maintain really good monetary conditions in Switzerland. Now, this is where I say we cannot do something. That doesn't mean we cannot do anything. And that is where I would come to the risk part. And in particular, there is quite a bit of analysis that is being done, and we are doing quite a bit internally as well, and we're engaging also with academia to try to see what does it mean to do a good risk management and to manage those reserves in a way that are really sustainable going forward. And I think you wrote a very interesting paper with with your co-author that looked at, for instance, well, maybe there could be a very easy way to look better for the S&B. We could, for instance, take out some of the worst sinners in terms of pollution, in terms of CO2 emissions. We could just take out a good handful of them and we would look so much better in terms of CO2 intensity. Well, my job is not to look good. My job is to do my job. And so the idea is, for us, the important question is not to look good. For us, the important question, assuming we were to reduce CO2 emission tomorrow on our balance sheet, my question would be, and the question I have to answer to is, what does it mean? Does it really make the world more sustainable? Does it really, and that is where all the interesting research that has been coming up shows, which is really interesting, is that divesting is not necessarily, divesting short-term immediately is not necessarily the right answer to really capture opportunities and to really reduce the cost going forward. So for us, we have a long-term perspective. A central bank is here to stay, and we have a long-term perspective. And so there's a lot of work to not just look for easy solution, but solutions that really go through time and that are going to allow us to move forward in a sustainable way.
Thank you, Andréa. So just perhaps for context, the E4S has a sustainable finance platform, and we have, because the Swiss National Bank is such a large player, there are several papers that deal with the issue. What could the Swiss National Bank do, and should it do it? Patrick, you don't have to answer this question, but if you were running the Swiss National Bank's portfolio, what would you do?
I'd be very happy to do that. And we're working on it, aren't we? But I think everyone is working on the same issue here, is to make sure that whatever the intervention of asset owner it is completely credible and impactful and corresponds to the overall objectives of the assets that we are responsible of. And I think we all agree, and I think asset owners, and you can see, for instance, at the outset of this, or at the close of this COP26, how many of those commitments have been reinforced. That's perhaps one of the key takeaways. Sorry, I just move away a little bit of your, but one of the greatest key takeaway of COP today is to see how finance has finally gotten into the center of the discussion as being a major driver, because it has gone so by illustrating not only the necessity to constrain finance into it because capital is needed, but it has gone into the center because capital has itself discovered that there are opportunities to seize, and there is a responsibility by the asset owners as well as by the asset managers to use these opportunities correctly. Now, just to go to your question, I think it goes to, unless I'm mistaken, your question goes really to the role of divesting versus keeping positions into a portfolio.
Yeah, just like if you got a mandate to run for a passive asset manager money, what can you do? What would you do?
Exactly the same for any type of asset owner or client. I would simply make sure that the narrative about why it is important to look at the portfolio with different lenses today is well understood, that we speak the same language in terms of what is it that we want to achieve, that we have defined metrics that we can measure, or impact measurement metrics, and that we can measure the progression and also the risks that are taken through the decision of transforming the portfolio correctly. Once we have that, and I think we have most of it today, we can move with any kind of portfolio, except for the fact that some of the portfolios are much larger and then create some risks that are very different from the smaller ones. And also some portfolios are invested in instruments that are less effective in trying to actively modify the composition of the portfolio itself. And this is true, for instance, for index owners, which have more difficulties perhaps. And there I would simply call to our own profession and say, look, if big asset owners want to find solutions, they should also put the pressure on the asset managers to try to find out what could be the solutions and develop these discussions. And if the asset managers do see that there are perhaps issues that relate to the instrument, they should go to those who provide those instruments and ask them, take for instance index providers, to correct or propose measures to correct perhaps the alignment of the portfolio according to what we want to achieve, i.e. net zero, for instance, in terms of the Paris Agreement.
Maybe I can add a few words. Thank you for the advice on how to manage our balance sheet. It's not that far from what we do, but there are some complications. I think it's very important to always remember it's easy to look at our balance sheet and say, wow, that's a big balance sheet. It is. But it is just as important to remember we are not just another asset manager. We are a central bank. The source of that balance sheet is very clear. It's based on our intervention in the FX market. It's unrealized profits that we have on our balance sheet. Our balance sheet has been growing very fast because we're countering the very strong pressure at time, particularly in times of uncertainty of the Swiss franc. It could also come down. I know right now you seem it impossible, but trust me, the world can change and can go down. It is something that we use as a cushion to allow us to do what we need to do, which is our mandate that we do in the interest of the entire country, which is price stability. But now, the other thing that I would say, our risk profile is very different. We cannot hedge against our biggest risk. So it requires us, the one thing we can do is diversify. Our key words in how we think of a balance sheet is diversification, diversification, and diversification, and liquidity. Liquidity as well, because we need to be able to move. We are large. We're not just couple of millions that you can try to go into exotic markets. We are very large and we want to be neutral in the sense we don't want to create market turbulence. And we would if we were to shift just 1% of our balance sheet. It could have a big ripple effects. So it's very important that we diversify and that we remain close to where the markets is. But that doesn't mean, let me say one more thing, that we don't think about this issue. And there's one thing that we also feel very, very, very strongly about is that our balance sheet has to, we cannot move proactively with it. We cannot use it to promote some kind of structural policy that is beyond the scope of what we're allowed to do. But our balance sheet ought to reflect the principle, the fundamental values and norms of the Swiss population. And that is what we do with negative screening. We have a very, very broad policy of negative streaming. It's not only, it is on environment, not only, it's also fundamental human rights. It's of course about weapons or weapons that are not allowed in the international community. And we have just in December also moved one step forward. We're not allowing to have on our balance sheet any producers of coal, of thermal coal. So we are moving forward, but we have very strong restriction because we're large, because we have a mandate. But it is ultimately important when we're clear about the risk. Oh, and the last thing we do work also with, we have a very large equity portfolio, so we can also exercise our voting rights, which was what we do actively on the corporate governance issue, because they're the clear standards. So I come back to it's very important to understand the risk, how we can address things, and that is something we definitely do and will continue to do.
Thank you, Andrea. If I may, we have another panel afterwards that talks a bit more about the activism part, but I wanted to combine two things that both of you have said. One is this idea of some sort of exclusion. The other one is the idea of finance, of really allocating capital. So here's one thing that I want you to help me understand. Sometimes you hear that you can do sustainable finance and you can have outperformance, and that's something that I never understand, because my thinking goes as follows. So I allocate capital to some companies that want to promote some sort of environmental or social factor. I withdraw capital from companies that don't do well. And why do I do this? Because I want these companies to have a decrease in price, and in that sense I want them to have a higher expected return, because that increases their cost of capital, it makes projects for them more expensive, and that is the allocating function of capital. But that means that a portfolio of sin stocks will naturally outperform a portfolio of ESG, of good ESG stocks. And I think people confuse the realized returns over the last 10 years, where we just became much more aware of these issues, and it was a good thing to hold an ESG portfolio with future returns, with expected returns. And I'd be very interested in your thoughts on this.
Well, there's there's a different aspect to your question. First aspect is the idea of exclusion and the idea of divesting. Divestment is a choice. It's a choice. And the question is, when do you make that choice? Do you make that choice ex ante because you believe that things do not belong to a portfolio, and then you go into the problematics that were just mentioned about diversification, risks, etc., etc.? Or do you look at your portfolio differently and just look at where are the possibilities of having more influence on a portfolio, but not in the sense of asking a company to decarbonize just for the sake of being cleaner, but where do you have influence to make sure that what you own will encompass less risk tomorrow, as you just mentioned, than today? And if you have the feeling that by engaging, which is a very important activity, of course, of the financial sector today and has developed very actively, and I'm not talking about activism here, I'm talking engagement, i.e. discussing with companies, setting objectives, measuring those objectives, and setting timeframes within which you can decide or not to keep the company, then divestment could be a choice at the end of the period you've given yourself to measure progress. Say, look, this company is just not doing what it should do, whatever the sector is, and is going to be a major risk one day for my portfolio that I don't want to take, and then you divest. The opposite is this private equity issue of recapturing all those companies that you're divesting from and making great profit short term. Yes, it is an issue, but sustainability is linked to the long term, not to the short term. And again, if you do your job correctly, as a professional investing and allocating capital, you should make the big difference between those short-term profit opportunities, which, by the way, may be hit the next day by government activities such as pricing externalities. Think about all the fossil oil investments that private equity will take very nicely while oil price, like now, is going up because we need electricity, etc. Think about introducing carbon prices next week, because tonight, perhaps the ministers will agree that it should be not 3, but 100 a ton. And if it is the case, the value of this portfolio will encompass a huge risk as well. So I think we should look at it as a long-term approach to portfolio risk, and then use divestment choice when you have extensively used the opportunities to influence the risk in a good direction in the portfolio, but not before you've done that.
So a few things. I agree, and one of the main thing I find is to bridge this is first the importance to go from a short-term perspective to a long-term perspective. And if there's one thing the sustainable finance has helped us to do, is to help also in the investors community to understand it's not just a quarterly horizon that they should look at, but it is a longer perspective. To the exact question that you ask, the one thing we've been saying and dealing with is a concrete example. It's not a company, but if you look at the behavior of green bonds, right? Green bonds have been now issued for quite some time. Now they're growing. We hold actually quite a big portfolio of them, but we don't hold them because we've decided to buy green bonds. We hold them when they're in the right currency, in the right country, and because they make sense from a risk-return perspective. But what is really interesting is to look at the returns of these green bonds, right? Should there be a premium to it, or should it be positive, or should it be negative? You can go both ways, right? They should be cheaper because in the end they will make you more returns, or you think of green bonds, it's a way of subsidizing an industry that otherwise doesn't get the capital. So these investors are willing to pay more to get into it. For a long time there was no difference. Absolutely no difference, which really economically should make sense, because otherwise, why would they be green bonds? Now we're starting to see a small positive premium on them. The price goes up, but partly it's purely demand driven. There's a demand for these green bonds, and the supply is still very short. So I think there's a lot happening there. In the end, I think it is about making sound investment decision. And in my view, the most important is really, and this is something where we really can help, is to have that longer term vision and not just looking at the returns, but it is always returns over risk. And the question is, yes, but those risks, over what horizon do you look at them? And I think that's where you get a slightly different picture.
Thank you, Andrea. Perhaps one question that we broached on a little bit is, now we talked about green bonds, we talked a fair bit about carbon emissions, but one of the luxuries that we don't have in finance, the first panel talked very much about a very specific ESG issue, but when it comes to finance, there's just so much in environmental and social and governance that we are talking about, and it's all mixed together. So in the end, we are taking gender diversity, we are taking whether a company has a good board, we are taking CO2 emissions in million tons, we are taking the approach to deforestation, and we are mixing it all in an index between 1 and 100. And that means in the end, perhaps not as much as it should be, and it also opens the possibility for many players to say, we do something about ESG, and so that's how you can have trillions of assets managed in an ESG compliant way, but it's all very vague and not concrete enough. So, Patrick, you have taken a very stark approach by having created a B Corporation, by when you go to the webpage of Lombard Odier, I think I can say this, sustainability is very much at the forefront. For us as investors, can you give us some advice? So how do I see whether somebody really means it as an asset manager, and whether somebody is just having a greenwashing approach?
First of all, we have no lessons to give. We're all students of this transformation, and we should all learn from each other. So I'd just like to say this, and when I say it should be combined forces between government, civil society, academia, and perhaps the real economy, I really mean it, because it's a complex issue, and that's why, by the way, we simplify some of the complex as well when we talk to investors. I think the first point I would like to mention is that, in as much as we talk today Web 3.0, we should look beyond ESG. ESG has created a jungle of standards, of labels, of concepts that is very confusing indeed to investors. So I would agree with that and acknowledge that first, and perhaps the industry has failed to rationalize this process, or perhaps it's gone too fast. But the good news is that it doesn't matter that it went too fast, because what is today important is far beyond ESG itself. ESG, if you look at some of the reports that are really talking about greenwashing, first of all, I welcome those who do look at it, because we need to be criticized to progress. So it's not an issue of liking it or not, but I think we are confusing concepts. If you look at ESG today, you're looking at the policies of a company and what they've done and achieved until here. I mean, if you look at sustainability and the sustainable transition, you have to look at the future and how the company is going to be aligned or not to reaching some objectives. And in order to do that, how the company is changing its business model. And that's what we're trying to do today by defining methodologies that will, as we said before, try to look for instance, the issue of climate. But mind you, I think nature-based types of solutions for climate and for biodiversity purposes will come very quickly as well. And that, in turn, will have a direct impact on social issues, as we all know. I think this is where the effort is now being put, trying to develop systemic approaches to portfolios that allow to identify the content of a portfolio when it comes to being aligned or not with those objectives that we agree with. If it is 1.5 degrees Celsius by 2050 or by the end of the century, we know today that 6% only of the companies or the large caps of this world are aligned to this objective. So that means there's 94% of the companies. It's good news for investors to look at in terms of investment opportunities. Look at those who can perhaps be transforming themselves productively with the right measurements and targets being put in place by the financial sector, so that we are sure we're making the right choices. One of the most recent development, including at the COP, and of course at Lombard Odier, we're very happy because we were at the origin of this development, is the measurement of temperature of a portfolio. The implied temperature rise concept that has been now pushed by McCartney alongside the TCFD working group is exactly going in that direction. What is the contribution of a company, or a sector, but a company to the elevation or the reduction of the temperature of the world, and is it going in the right direction to reach the net zero? If you can do that, you're going much beyond the ESG. You know that you're going to look at an investment that is contributing to reducing the problem of climate in this planet. And that's probably the first step to take. If you look at nature-based solution, deforestation is the greatest example, as I was mentioning before. I mean, deforestation is the third largest sources of emissions today that you want to try to tackle. After the US and China, it's the third largest. So to make an agreement about how not to deforest anymore is as simple as that. Do we think it's an important source of reduction of emission or not? If yes, what does that mean? It means stop investing in companies that systematically invest in deforestation business models, and even if better, try to invest in nature-based solutions that do somehow create reforestation.
So you would just order them by just some common measure of importance, and then those are the ones that the goals that you would tackle first?
Yes, I think we should today systematically have risk return temperature of the portfolios everywhere, and that the investors can discuss about it with the professionals. What does that mean? Why is it higher than last time I saw you? Was it lower, etc.? How do you measure it? What are the verification process that you put in place to make sure this is correct, etc.? As you can and will do, I hope, the same for nature-related or biodiversity issues tomorrow. I think and I hope that the Kunming convention that was not possible this month will happen very soon next year, so that we can define also, as much as we've defined in climate, some of those metrics that will help us deal with this issue as well. So we are getting there, and this is a role of collaboration between politics that will say, okay, temperature is a good measure, 1.5 is a good goal, governments will align or not. The economy will say, okay, if you tell me that I have to do efforts here, I better do it. Government will say, companies, if you want to show that you're 1.5 degree, show it and disclose it. And finance that will say, we go and going to go into this direction.
So, Andréa, before we open it for questions from the audience, you said something that resonated with me. So you said, if the Swiss population agrees on some of these topics, we are going to do it. How do you implement this? How do you know what the Swiss population wants?
So that's a really important question. And so what the population wants is what is enshrined in the law and regulations. So for instance, this is how we do our negative screening policy. We look at so we follow the sanctions in terms of the armament policy. We look at what agreements Switzerland has signed. If there had been a CO2 law, we would have had to also implement it. So for us, it's very important, right? We can't be captured by a particular group, you know, because it's not about who we are and what we do. We need to be able to base it on what the Swiss population has really put. So it's about the decision, what happens at the Parliament, at the Conseil Fédéral. Those are kind of things that then we're going to implement them as well.
Thank you. So a couple of questions from the audience. One is a question, the role of Fintech. It's Fintech and sustainable finance. Will this help us move towards sustainable finance? Just new solutions in Fintech, new investors in Fintech, new people in Fintech? You have an opinion on this?
That's it.
All right. Fintech is a fantastic ground for solutions. As we mentioned before, there's two ways to be impactful in sustainable investing. One is to look at the companies that change. The other one is look at companies that create new solutions. Fintech is part of the space where you can find tremendous new ideas in the field of more sustainable ways of doing or producing services or goods. And I think in this respect, it has to do with the technology itself that can perhaps allow us to identify areas of investing today that we could not perhaps have identified before. Think about the data space again, with geospatial data today and technology firms that are trying to bring together those data with the needs for capital. It's really interesting to see how easier it is today to invest in effective agricultural types of solutions than it was in the past. That's a good example. If you take another example, everything that has to do with inclusion, talking about the social aspect to it, is of course extremely interesting as well. Putting together, suddenly, as it's been done in many countries now, in particular in Africa and other countries, a fintech service, financial service at the disposal of everyone without having the necessity to do anything but to use a phone or a mobile application, I think is a great way to invest into some of the most difficult to tackle issues that are the social issues of this sustainable transition.
Yeah, these are great examples. And Andréa, would you like to add? Or?
Well, fintech, absolutely. I mean, anything that is about innovation, I mean, we have to see how we can capture it and make and really help us seize all the opportunities that there are. One is clear, is in all the area of data, right? In order to manage money, the more data, the more and you can also help in the type of analysis that you can do. So I think everything that's happening in artificial intelligence, how you can really use to really, because there's a lot of question, we still need the data in many areas, so we're still hoping to do data, but once we get that. But then you have the entire spectrum. You have the data, which can work in different areas, but then you have all the digitalization, all to the new world, what I call the new world, to the DLT world, to the distributed ledger technology, to the blockchain technology. And there's a lot of very interesting application there. Can they help in terms of sustainability? That's to see. But then there's also, nothing comes for free. Then there's also the question, if you think about all these new platforms that open up new opportunities, and we're actually ourselves very deeply active in some very interesting projects. But then comes the question, how much energy do they use? So it's really about ultimately not thinking there's an easy answer, there's no silver bullet, there's a lot of work that needs to be done, and we need to keep a holistic perspective to make sure we manage all the risk and we don't just address one at the cost of the other one. But I think absolutely there's the really interesting areas of work that are being done.
Perhaps can I just make an additional point? I think fintech could be extraordinarily useful when it comes to having impact as well. And I think we should look at it as a source also of improvement of this whole set of instruments that we have in finance to be more powerful in accelerating this transformation. Take the data, artificial intelligence type of algorithm will allow you today to get data and read data in a way, for instance, qualitative data that are extraordinarily useful and missing still to appreciate the impact of an investment. And that's something that is being done here in this country, actually in this region. There are companies that were created here to do that. So that's one. The second, which I think is really interesting, is the liquidity issue. Is to try to develop mechanisms that allow otherwise very limited, with the product with very limited liquidity to be available anywhere in the world. Some of the impact instruments today are too narrowly defined to be accessible by a wide range of investors. By some of the fintech mechanisms that are now being developed, we can imagine liquidity to be suddenly available for those investments.
Well, there's one more question that people have is going strong on the chat, and that's for you, Andréa. Somebody quoting from the website of the Swiss National Bank. It is obliged to act in accordance with the interests of the country as a whole, quote end. Do you not think that, I think that's a leading question, that it is important to protect Switzerland from climate change?
As a citizen, absolutely. As a central banker, yes, from a risk perspective, we need to understand how climate risk affect our mandate. But it's not, the central bank, the SNB, has to act in the interest of its people according to its mandate. And its mandate is to maintain price stability, take into account economic development. And don't get me wrong, we're not hiding behind that mandate. If this mandate isn't there, it's very destabilizing for everybody, for households, for firms. They cannot make the decision on what kind of wages or prices to set. Households don't know when to consume. Savers don't know how much they need to put aside for the retirement. It makes it really hard to create sustainable prosperity. And if we don't achieve this mandate, no one else can, because you need independence. And why do we need independence? Not because we like to take our decision behind closed doors. No, because sometimes we're the only ones. We have to take very difficult decisions that we couldn't take if we needed the political agreement at the time. We need to maintain over time. We need to convince all of you that we're doing a good job. But at the time we take the decision, we need to be able to take them, even if everybody says, we're not really happy about it. Things negative interest rate, things when we took off the minimum floor. So this all to say that it is very important. So yes, we have a mandate, but it's important that we maintain our focus on this mandate so that everybody else can really decide in a political dialogue, how do we take care, how do we address climate change in Switzerland?
So Andrea, this actually leads to this is good, but it leads to the second most popular question, which is, let me combine the second and third one because we're getting to the end. Well, shouldn't then the Swiss National Bank get a larger mandate? After all, other central banks are much more upfront or pushy on the ESG or sustainability issues.
No. So that could be the really easy answer.
This is the first time I have heard a clear answer from a central banker, so thank you.
Well, we try to be clear. It's just not always easy. No. Why? Not because we're afraid to have even more work and more responsibility. No, the point is, I come back to, we've been enshrined with one mandate that is incredibly important to make sure there's sustainable prosperity in Switzerland. And if we take on other mandates, what is the biggest risk? Conflicts of interests. Think about it, and the issue is, in order for the tools that we have for implementing monetary policy, they're not good tools for doing other things. They can sometimes work in the same direction. For instance, green bonds, right? We buy green bonds, that's good for the environment, but assuming we were suddenly to say we only buy green bonds, might be good. Well, it might increase the prices, but might be good, right? We would definitely bring capital in that market. Imagine we suddenly have to change our monetary policy and we have to sell these green bonds, and especially if they're not yet as liquid as the US Treasury market, although even the US Treasury market has gone into some illiquidity tremors, right? Then what would we do? By selling suddenly a large portion of our balance sheet, we would be really destabilizing there where we would, by that, have a mandate. So for us, if you want us to do a good job, which is incredibly important, we have to have clarity of mandate. And that mandate needs to be clear, we need to be accountable for it, and we cannot have conflicts of interest with that mandate.
Thanks a lot. The last question perhaps for Patrick, because I don't know whether I can invite a central banker to speculate. But if I can ask you to speculate, Patrick, 10 years from now, sustainable finance will have changed ...
The approach of the Swiss National Bank towards sustainability. Just joking, sorry. No, but I'm really hoping that everyone understands that the central bank is doing a fantastic job making sure its mandate is being ensured, but we also depend a little bit of being all convinced so that finance can move, and not only finance from a private sector, but the finance in general can move in the right direction. So the central bank, whatever it is, wherever it is, has the instrument and the tools and the metrics and the methodologies to take other decisions that will facilitate what we're just talking about is going to be happening very quickly. That's one. The second, in the future, I see what we're talking about becoming mainstream. That's clear because, as we said, investing sustainably means simply investing well. From a fiduciary point of view. The third is that probably finance would have contributed to reach the net zero objectives, at least by 2030, have eliminated 50% of our emissions. And the fourth element that I absolutely see as possible is that by 2030, deforestation would have ended, thanks also to finance.
Thank you very much. Thank you both for being here and for sharing your thoughts with us. Thank you very much.
Thank you.